All right, welcome to today's broadcast. Thank you everyone for joining. Please like this video and subscribe for more videos like this. We'll be fielding questions in the live chat. Please let me know if you have any questions. You can post them there. All right, so today we're going to be going over using debt financing, or what is referred to as a non-recourse loan, to invest in real estate. So let's go over the basics in terms of what a non-recourse loan is. So a non-recourse loan is, in the context of a solo 401k, is going to be a loan to somebody that wants to invest in real estate. So with our clients, one of the top reasons that people set up accounts with us is to invest in real estate. So a typical scenario would be somebody wants to buy a rental property. Let's say that they are self-employed, they've got, they're a realtor, or maybe they're a solo practitioner attorney. And let's say they have, $100,000 in their IRA. Maybe they used to work at a law firm, or they used to work as a W-2 job, and they had accumulated 100,000 from that position. So then rolled it over to an IRA, then they're self-employed, they don't have any full-time employees, so they set up a solo 401k. So with our plan, which is an IRS-approved plan, you can invest in real estate. And so you can actually use a leverage. It's not commonly known, but that's a common strategy with our customers, is they're able to leverage their retirement money to invest in real estate. So the way that you have to do that is through a specific type of financing, which is called this non-recourse loan. So the loan is to your 401k, so it's to the trust. It's got to come, of course, from a non-related person, and then the proceeds would be used together with the retirement money to buy real estate. So let's say that you get a $100,000 loan, $100,000 from your retirement account to buy a $200,000 property. So the loan is not going to be to you. It has to be to the plan. So the borrower is going to be your 401k plan. And then you are going to be signing the documents as the trustee of the plan. So the recourse of the lender is only against the property itself. Under those 401k rules, you're not going to be allowed to personally guarantee that loan. You're not going to be able to say, use your personal residence as collateral, or even just sign it as a guarantor personally. You're not even going to be able to have the only recourse of the lender is going to be to go after the property itself. So, and we'll talk about practically the implications of that in a later slide here. So why someone might use non-recourse financing, it's similar to any type of investor that's using leverage to invest. I mean, you can buy a bigger property, right? You could maybe buy multiple properties. Even if you have enough to buy one property in your 401k plan, you could split the money and buy two and leverage it by obtaining that non-recourse financing. So otherwise, it also might allow you just to invest in a property that you might otherwise not invest in, just because you're able to access more money. So again, just the key with a non-recourse, as it's laid out here in the slide, is that you as the account holder, your family members, and your business, none of that is going to be involved in the loan. You can't be a guarantor. You can't lose it as collateral. The only recourse is the property itself that's owned by the plan. So let's go through some of the steps here to invest in property using a non-recourse loan. First, of course, you got to set up a plan that's going to allow you to invest in real estate. So that's something, of course, that we offer. Then you've got to fund that plan. So you could fund it by making contributions. You could fund it by rolling over money from a pre-existing retirement account, like a former employer plan, or a non-Roth IRA. And we handle that transfer process as part of our services. Now you've got to go and find a non-recourse lender. There, you can't just walk into your local Wells Fargo branch or Chase branch and obtain a non-recourse loan to your 401k. You got different options though. There are specialty lenders out there. We have a number listed on our website, a number of those providers listed on our website. We've got some listed on this slide here. You've also got just private individuals out there, as long as that person is not a related person. So you can't have like your spouse loan money to your solo 401k, to even if it's on a non-recourse basis, to buy property. So you go out there, you find somebody though, and then you put together the offer, the contract, put the money down. The lender then releases the funds. You fund the closing, you buy the property. The property is taken in the name of your trust. And then of course you got to follow the other rules, which we've gone over in other presentations when it comes to investing in real estate. You can't use the property for personal use. You're not going to be able to, work on the property and no sweat equity. All the money comes in and out of that 401k account. So in terms of the money going in and out of that 401k account, your 401k is going to need to pay back that loan. So the non-recourse loan is being paid back with the solo 401k funds. So you're not paying it back with money from your personal account. You're not paying it back with money from your business account. It's got to come from the 401k account. So what does that mean? That means that you have to plan accordingly. So for example, thanks for saying hi, Cindy. Please let us know if you have any questions in the live chat there on YouTube. So, but yeah, I mean, like I was saying, you have to plan accordingly because the 401k is going to have to pay that loan back, right? So if you roll over all your money, you use it all to buy the property together with the loan. If you don't have additional money coming in to pay that loan back, then you're going to have to somehow get money into that 401k. So if you have another retirement account that you didn't roll over, you could always roll that over. Or if you're eligible to make contributions, you can make contributions. Or of course, if you have money that you left in the plan, that would, prudent planning to service that debt. Or of course, you could use the income that's coming from the investment. Let's say it's a rental property. You take some of that rental stream and you pay it back to the bank. So, and again, this is a reminder, like I was saying, that those 401k funds need to be used to pay property expenses, whether it's the non-recourse loan payments, whether it's property taxes, insurance, or other expenses. It's got to come from that 401k account. And even if you're able to, say, make a contribution from your self-employment income, you want to put it into that account before you pay that expense and make sure you document it as a contribution. Make sure it's within those contribution limits. You don't just go and pay somebody out of your personal account, even if you are eligible to make a contribution. Okay, and finally here, let's end with some solo 401k. We got another person here joining and chatting. I appreciate that. Thanks for the comments. So with some tidbits here. So just to recap, so the loan must be non-recourse, and it's got to be to the plan, not you. So the lender is not going to review your credit. Why? Because you're not able to guarantee that loan, right? Your assets, your personal assets are not relevant. So there's not going to be a credit check on you. If there is, that's a red flag that the lender doesn't understand that this is a non-recourse loan. And then LTV, this is what I was alluding to earlier. From a lender perspective, they're going to price it accordingly because they don't have recourse against you, right? Like if you live in typically like with your personal mortgage, you might have 10% down, 20% down. If you don't pay back that personal mortgage, your lender is going to take your property, sell it, to the highest bidder for, in an auction, and then go after you in all likelihood for the balance of the debt. In this case, the lender doesn't have that recourse. So they're going to price it differently. They're going to price it they're probably going to at least want like 40 or 50% down. Because if that loan is not paid back, their only recourse is to go and get that property. And then finally, one of the advantages in this last tidbit here, no UDFI. UDFI refers to unrelated debt finance income tax. So, and this is a unique advantage of a solo 401k versus an IRA. So under the rules, there's an exception under the unrelated debt finance income tax regime for investments in real estate to acquire real estate made by a 401k using leverage. So if you buy real estate using debt financing, using a non-recourse loan with your IRA, if you leverage your IRA money to buy real estate, the income that's generated by that investment is going to be subject to the unrelated debt finance income tax. However, if you make the same investment inside your solo 401k, where you acquire real estate using leverage, using that non-recourse debt, there's an exception under unrelated debt finance income tax to exclude that 401k from the tax. So that's a really big advantage of a solo 401k versus an IRA. So that's why we see a lot of people who are eligible for the solo 401k preferring it over the IRA. I mean, there's other reasons to consider, and we can go over that in a future webinar, but that's definitely a key point there. So thank you so much to everyone for joining and commenting in the live chat. We'll be posting this later on YouTube, and please like this video and subscribe for more videos like this. Thank you so much.